Why did Bitcoin take such a big hit from coronavirus? All markets took a hit from the coronavirus outbreak, as the impact on the economy would be deflationary, with shutdowns or less efficient supply chains and the closure of retail stores. There are less goods produced and less consumer spending investment. The effect on economic growth and people's incomes would then be negative, which drove stocks to sell off as many companies were hit by a loss of revenue, customers or disrupted supply chains. Even safe haven assets sold off as investors and traders flocked to the safety of cash. In such a desperate situation, people will prefer to hold cash to buy the things they need, such as food supplies and other things that they need for a lockdown. Traditional trading venues also told clients to reduce their position sizes, so there were a lot of liquidations and reduced positions, which reinforced the panic selling. The data from the blockchain shows that BTC was mostly sold by newer investors held BTC less than 1 year for cash, presumably as a precaution in case the coronavirus outbreak worsens and they need to buy food, water, and other essentials. Since BTC can be liquidated much easier than other assets i.e. gold, we saw a sharp decline compared to gold and equities. Another factor is the small market size, where the liquidity in Bitcoin markets is much lower than in traditional markets. Because of the lower liquidity, BTC exhibits sharper and more exaggerated moves when people are panic selling, as we saw when BTC fell from around $8,000 to $4,000 in a single day. Bitcoin itself is a deflationary system, meaning that prices quoted in terms of BTC should fall over time, as there is a fixed supply of Bitcoin and the monetary policy is algorithmic. In a deflationary environment, such as the current climate caused by coronavirus, there's less demand for a deflationary currency. Since there's downward pressure on prices in USD terms because of the lower demand, consumer spending, investment, and reduced production capacity, this leads to a negative effect on inflation expectations. And if people anticipate inflation to be lower in the future, they'll wait as long as possible to spend their dollars. And if people perceive inflation to drop in the future, then there's less reason to buy Bitcoin, which is a safe haven against inflationary episodes for fiat currencies. Bitcoin hasn't lived through a major economic, financial crisis up until this point and represents a major test for the cryptocurrency. While the reaction was initially negative, it seems that BTC is now rebounding and following gold higher, where the latter has already recovered its losses from the Black Thursday, March 12 market crash. There is no doubt an element of general malaise in all financial markets. However, the BTC crash had little to do with C19. In simple terms, trading in crypto has little or no reflection to the value of the coins or the potential of the future worth of their applications. It is dominated by traders anticipating and effectively gambling on price changes. It's the exchanges that are responsible for this situation. There is a method of leverage trading which allows you to apply multiples of your stake in anticipation of a price movement. These facilities are offered by the exchanges and promoted by most influencers, most of whom benefit from a commission for referrals and subsequent trading fees. So someone may commit $100 at 100x leverage, i.e. effectively a $10,000 trade on a coin going up in price long or going down in price short. According to the trade, there is a cut-off point where the trade is liquidated if it goes in the wrong direction. So, hypothetically, if I bet my $100 with 100x leverage on my coin going up from its current price of $500, i.e. taking a long position, I must set a stop value below which my trade will default, say $420, the equivalent of 16% fall in price. A sudden, unexpected drop in the price by 20% to $400 loses me my $100. The volatility in the markets can be recognized as manipulation not particularly by whales, i.e. rich individuals, but by the exchanges themselves with their massive wealth and influence. With sentiment, wishful thinking, constantly seeking the uptrend, i.e. betting long, a sudden dip in price can liquidate positions, bets, and benefit the exchange's profits worth millions of dollars. The figures involved can be, and are, researched and evidenced. Many YouTubers take the time to do this and share with anyone willing to watch their sometimes rather challenging output. Simple, People need money to pay for rent, utilities and day-to-day expenses. They stopped earning wages and their sources of revenue just dried. When one is in this type of situation, they reach to their savings. Some sell their stocks, some their bitcoins. Crypto whales and investors know that, some large trades on a thin order book and you crash down the price. Everybody starts selling because of panic and because they have to sell while smart money buys Bitcoin at cheap price. Holders are obviously not affected the slightest by this. Au contraire, they are always buying when the price decline and appreciate during market corrections.